Welcome to The Explainer. Today we are taking a deep dive into one of the most talked about, but honestly one of the most misunderstood metrics in all of investing, the PE ratio. And by the end of this, I promise you are going to have a complete toolkit to see right past all the market noise and find real value.
So let's just jump right in with a quick question. You've got two stocks in front of you. One is trading at $300 a share, the other is 40 bucks. Which one is cheaper? Which one is the better value? Seems simple, right? But the answer, well, that's where the real magic of smart investing begins. If you paused for even a second, you've just stumbled upon the number one rule of professional investing. A stock's price tag all by itself is pretty much meaningless. Knowing a stock costs $300 tells you what you pay, but it tells you absolutely nothing about what you actually get for your money. So, here's the game plan for this explainer. We're going to build your valuation toolkit from the ground up, step by step. First, we'll lock down that core idea. Price is not value. Then we'll introduce your first real tool, the PE ratio, and its even more powerful cousin, the PEG ratio. We'll even peek inside a system used by investing legends like Warren Buffett, and finally, we'll get into the advanced stuff that really separates the pros from the amateurs. Let's get to it. Okay, before we touch a single number or ratio, we have to get this one concept burned into our brains. Price is what you pay. Value is what you get. Those two things are almost never the same, and that gap between them, well, that's where fortunes are made and lost. So many people out there buy stocks knowing only the price. They'll say, hey, I'm paying $300 a share for this company. But if you ask them what they're getting for that price, what the business underneath is actually worth, they kind of just shrug. They're running on hope. And that right there is the huge difference between gambling and investing. And this brings us to our very first tool for figuring out that value, the price to earnings ratio, or just PE. This is the first question every single pro investor asks to start digging into what they're actually buying. So, what is it? Put simply, the PE ratio answers one question. For every single dollar of profit this company makes, how many dollars do I have to pay to own it? That's it. You just take the stock price and divide it by the company's earnings per share. And all other things being equal, a lower PE is better. It just means you're paying less for that same slice of profit. Let's make this crystal clear. Imagine a little lemonade stand on the corner. Its stock costs $3 a share, and it makes 30 cents in profit for every share. Simple math. 3 divided by 0.30 gives you a PE of 10. That means you, the investor, are paying $10 for every $1 that little stand earns in a year. Now, if the lemonade stand across the street has a PE of 20, you'd be paying $20 for that exact same dollar of earnings. See? You can immediately see which one is the better deal. Now, get this, because this right here is a total game changer for understanding PE. It's like a magic phrase. For a company like Johnson & Johnson with a PE of 1857, it means exactly this. For every $18.57 I invest today, the company will generate $1 in profit over the next year. See how powerful that is? It turns this abstract ratio into a direct, easy-to-understand return on your investment. Okay, the PE ratio is a fantastic start. Seriously, just by using it, you're way ahead of the pack. But it has one massive critical blind spot, a flaw that can lead you to some totally wrong conclusions, so let's level up and see how the pros fix it. So let me ask you this. If you've got two companies and they both have a PE of 15, does that automatically make them an equal value? Not so fast. The problem is that the PE ratio is just a snapshot in time. It's based on what happened in the past. And investing, well, that's all about the future, right? The PE ratio tells you nothing about where a company is heading. And here it is, the big reveal. The PE ratio completely, totally ignores a company's future growth. Think about it. A company that earns $1 today, but is going to earn $2 next year, is way more valuable than a company that's just going to earn that same dollar year after year. True value is a mix of today's earnings and tomorrow's growth. We need a tool that sees both. And that's where our next tool, the PEG ratio, comes into play. It stands for price/earnings to growth, and it's a brilliantly simple upgrade. You just take the PE ratio and you divide it by the company's expected earnings growth rate. The rule of thumb is really easy. A PEG of 1 is considered pretty fair, but anything under 1, well, that could be a fantastic deal. It suggests you're getting more growth than you're paying for. Okay, let's go back to our original question, but this time with our new superpower, the PEG ratio. On the left, Apple. On the right, Procter & Gamble. Now look at their PE ratios. They're almost identical, both around 14. Based on that alone, you'd think they're a similar value.
But now, let's add the game changer: growth. Apple is expected to grow way faster than P&G. And when you do the PEG calculation, the picture is suddenly crystal clear. Apple's PEG is a tiny 0.61. That's a screaming value, while P&G's is 1.55. And boom, there's your answer. The $300 stock is actually the cheaper one.
All right, we've gone from simple price to PE to PEG. You're already analyzing at a really high level. So now, let's see how a true master of the game, someone like Warren Buffett, puts it all together into a disciplined system for finding those deeply undervalued companies. So Buffett and his mentor, the legendary Benjamin Graham, they came up with this quick and dirty test for spotting bargains. It uses our friend the PE ratio and another one called price to book, or PBV. Book value is just what the company would be worth if you sold all its assets and paid off all its debts. The test is super simple. 1 is the PE under 15, 2 is the price to book under 1.5, and 3, the big one, is PE times price to book less than 22.5. If a company checks all 3 boxes, it's a huge green light that it might be a bargain worth digging into. Now, it's really important to know this little test is just a starting point. It's a filter, not the final word. The bigger philosophy is about finding wonderful quality businesses that have great managers and solid finances, especially low debt, that just happen to be on sale for some reason. That right there is the heart and soul of value investing. Okay, you have the main framework down. And honestly, with just what we've covered, you're set to do better than 90% of the people out there. But if you really want to level up to a professional mindset, there are a couple of key details, some nuances that we need to cover. This is a big one. When you look up a PE ratio online, you'll often see 2 kinds. There's the trailing PE, or TTM, which uses the earnings from the last 12 months. That's a hard fact. It's what actually happened. But then there's the forward PE, which is based on analysts' estimates of what the company might earn in the future. It's a prediction, a guess. Both are useful, but you absolutely have to know which one you're looking at. And always, always take those future predictions with a healthy grain of salt. And this might be the most important rule of all. Context is king. A PE of 20 could be crazy high for a slow-growing utility company, but it might be an absolute steal for a fast-growing tech company. You can't analyze a PE in a vacuum. You always have to compare it to other companies in the exact same industry and against its own history to figure out if it's really a good value right now. So you might be thinking, this is great, but how on earth do I find these companies out of the thousands that are out there? Well, let me introduce you to your new best friend, the Stock Screener. These are amazing tools, and they're free on most financial websites. You can literally tell it, hey, go find me every company with a PE under 15, a PEG under 1, and low debt. And it just does it for you. It does all the heavy lifting, saving you just countless hours of work. All right, let's put it all together. Here is your professional checklist, the step-by-step process you can use for any stock you look at. You ignore the price and focus on the value. You start with the PE to see what you're paying for earnings. You add the PEG to bring in the future. You can use the Buffett system to spot deep value. And you always, always check your context. This is it. This is your framework. So now you have the playbook. You know how to look past the sticker price and see what's really going on with a business. You can separate hard analysis from just hopeful guessing. So the only question left is, what are you going to do with this knowledge? How is this going to change the way you invest?